Do you do the Rim Flyers? You want your business to be better than it is right now. Get the Rim Flyers, put your information on there, go into real estate offices and actually talk to them. Click this banner over there. It doesn't cost you anything. I hope that worked. Now on with the show. So the Freddie Mac Weekly survey average for a 30-year fixed rate loan is 3.41%, at a half a point. And this is as of last Friday. So if your rates are higher than 3.41%, you're selling rates that are higher than the national average. If they're lower than that, you're selling rates that are, come on, what is it? That's right, lower than the national average. But truthfully, selling rates isn't a good idea, because all you do is set yourself up for failure. If rates tick up, you lose. If rates tick down, well, they were supposed to.
Not to mention that selling rates just puts it in the head of your clients to shop you, and that's when you run into the old bait and switch stuff that's going out there, which is never really fun. The question you should be asking yourself is, why aren't rates at 3% right now?
Because they should be lower, shouldn't they? Because the difference between the current 30-year fixed rate conforming loan and the 10-year T-bill is above 2 points, which is a massive spread not seen since mid-2012. So it makes you really think, shouldn't rates be lower? Shouldn't they?
Well, according to the Wall Street Journal, the reason is low rates stand to hurt overall bank profits because of falling bond yields. So the spread of 2.02% is where banks are making their profits. So a higher spread helps banks that originate and non-banks keep their profits up via yield spread to fight low bond yields.
They're making their money at the point of origination. The other reason is rates aren't lower is the faucet effect. And by the way, we just coined that term. According to the American Banker Association, home equity is still on the rise, which keeps people from thinking about foreclosing. And that's good.
But it also allows some folks to refinance out of mortgage insurance. You mix that up with a dash of Brexit, historically low rates, and what you have here is a good old-fashioned refinance market. That's what we've got, a refinance market right now.
According to the Mortgage Bankers Association weekly average, mortgage applications went up 14.2%. That's a big number, by the way.
So what that means with all this new refi activity is that lenders either have to A, staff up real quickly.
Let's think about that. Not enough time. Try something else.
B, make turn times on underwriting and fundings go through the roof.
That totally sucks because it just ticks off people when time frames get longer. Keep trying.
Or C, control your volume by keeping rates artificially higher than they need to be. When you get too many loans, you raise your rates to slow down submissions, hence the faucet effect. Turn down your mortgage funding faucet with higher rates. Oh, and if they do that, well, then the banks make even more money then.
Well, that doesn't sound like a very good option either. Try something else.
There's nothing, man. Those are your options. Staff up, increase time frames, or make more money via higher rates. Now, what do you think companies that think profits are really, really good are gonna do?
I suppose they're gonna keep rates higher than they need to be.
You get a gold star for that answer, Brian. And that, my friends, is why you're not seeing lower rates right now. Oh, and you could apply this logic to gas prices, airline tickets, and AR-15 rifles. People will still pay a premium because of unique market conditions.
Well, I don't like the options A, B, or C, but I get we have to pick one of them, so C would have been the most logical, thank you, Frank. But the point is this, regardless of the rates you sell, or regardless of the rates you even buy, or even the rates you want, as long as you're getting the rates today, you, yes you, are gonna do really, really well.
I did a show when you were gone about when we're in the valleys, rates. Everybody's so frantically busy. Everybody forgets to do all the good stuff, the right things that create longevity in this business. I'm telling you the stuff, we've been saying it for years.
Yep.
It's gonna turn, man. And when it turns fast. And the thing is, it doesn't have to go up very much. 0.5%, 1%. that's really not that much when you're sitting at 3.4.
Right.
Right?
Right.
And it just changes everything in the industry, and you're going to see loan officers getting out of the business in droves because they're going to go broke because their pipelines are going to go away. Mark my words.
Well, bond yields are not going to stay where they are because there's too much money being lost or perceived to be lost right now. So you're right, it is just a matter of time. So it is the behavior today that's really going to determine your longevity in the future.
That's right.
I get the low-hanging fruit, hit the refinance market, do a service to your clients, but see beyond the horizon.
Yeah, do it now. You guys have a great day. Forward, share, and subscribe. Leave us your comments down below. Catch you later here at the Natural Real Estate Post. Bye.
Bye.